Hey, Denise. Good morning. Happy Friday. Happy Friday, everybody.
Happy Friday.
Patrick said you were the guru at Fidelity. I've also heard Data Geek. I don't know which one you prefer, but...
well, either is fine.
Okay, good. And I mean that in a very positive way. Let's start with the fact that you are part of QRI, Neil Constable's group. Neil Constable spoke yesterday. But you sit with the equity analysts. Yeah. So you're not sitting in the pool of all the engineers and everybody else, but you're sitting more with the people that are doing the research every day. Can you talk about why that is?
Yeah, I would say I'm the least quant in QRI, and that's partly a function that I started in 1999 in equity research. And I am very akin to the fundamental analysts in the sense that my job really is to get the right names into our diversified products. I just do it differently. So our fundamental analysts, obviously, they talk to individual companies, they build company models, and they recommend individual securities. I don't do that. I really talk about sectors, I talk about industries, I talk about factors, I talk about the market backdrop, and I do it all through historical probabilities. So I'm looking for patterns in the data, I'm looking for anomalous situations that have been predictive in the past. We have great data sets for sectors and industries going back to 1962 that has valuations and growth that are very interesting, and I juxtapose that with all the macroeconomic data out there in the government databases to see all of the patterns that we can see in the market. And as much as it is always different this time, the patterns, despite the differences, remain the same. So I try to help our portfolio managers understand the macro environment in a probabilistic way and make sure that they don't make missteps in their portfolio on macroeconomic factors, and at the same time get the best ideas that I have into our funds. And usually the way they use me, which is why I think I sit with the rest of fundamental analysts, is to use me in conjunction with those fundamental analysts to build conviction. So if I'm saying no on energy and our energy team is saying no on energy, then there's more conviction in terms of either not owning or owning a sector.
So what's your day-to-day like? You've got people coming to you because they know you're a great resource, and you're going to them, you're doing presentations. What's a week look like for you?
Yeah, so there's a lot of looking at data. I mean, I do start my day looking at data. I have 10,000 data sets. I don't look at every one every day, but I look at a lot in a given day. But yes, it's always an interaction with a portfolio manager, sometimes with an individual client, sometimes with our sales group. I mean, everybody asks great questions about the market, and they're always interesting, and I don't always have the answers. So to the extent that somebody asks a question of data that I haven't looked at, then I get to go and look at the data. So my days always start with data, and they always sort of end with conversations. What I try and do, and I think I started this in the pandemic when we all sort of went home to our respective houses, was to stay engaged, which is whatever I was working on that week, I had to have the data come to at least some kind of conclusion, which maybe the conclusion was there is no conclusion, or this is not helpful. This is not a helpful way to look at the markets, but really there is weekly research that can help investors either understand the market or understand why I think that they should own what they should own. So it ends up in weekly research, and then always goes to monthly research, which I have an internal meeting that I call fact-oriented debate. So it's our sector spotlight meeting. I co-present with Roy Justice, who is our global technical strategist, and I will present my views, and then everybody basically argues with me about, well, you forgot this, well, it's different this time for these reasons, Denise, can you consider this? So it's my view on the market driven by all this history, and it's anybody can come, right? So our quant analysts come and debate. Our asset allocation research team comes, people from SII, portfolio managers from SII, our internal equity analysts come, and our diversified portfolio managers, obviously. So that's where all of my cohesive views end up, and it's an internal debate. And then that usually gets flipped to a monthly white paper. That also I do a quarterly webcast for clients because you can see I kind of like talking. So they're like, well, go talk to clients too. So I do a quarterly webcast for clients where a lot of what we have in those debates ends up in that webinar. So you kind of get a sense of what actually Fidelity views as core research.
So backing up a little bit, the meetings that you do where you say, you kind of argue, I can't imagine you've ever lost an argument. Is that in the classroom on the main floor by the elevators, 245?
No, a lot of it's on Zoom. So I will say I'm not a fan of hybrid environments because I can't quite see everyone. Yeah. So I do everything on Zoom, and then I can see whose video is up and who's not up. So then I can call on people. So actually, I find Zoom extremely helpful, and then anybody can log in from anywhere, and I don't have to worry about it.
I just mentioned 245 Summer. What's it like for you when you walk that building? It's 14 floors. I don't know how many thousand people are in there, but that's Fidelity, Boston. Everybody's there.
Yeah.
What's it like for you when you walk in there in the morning and be exposed to all the resources that are there?
Oh, it's great because you can talk to anybody at any time who's invested in any market.
Yeah.
Like literally, whether or not you're curious about bonds or equities in the 1970s, we have somebody who has expertise among those hallways. And we also have the chart room, which is just great history that you can see, hundreds of years of data. So no, I mean, the resources are unparalleled.
What is the library? I've heard Mark Schmale refer to it. I heard Peter Lynch refer to it when he was interviewed on the compound. What is the library?
You mean the chart room?
Summit? No, I heard there's a library.
Library? I don't know what
Maybe you haven't found it yet. But anyway, so that's a powerhouse for you. You're a sponge of all the information that comes to you.
Try to be, yeah.
And you're also on LinkedIn. Follow Denise on LinkedIn. She's a wonderful source for all of us consumers of information as well. So keep that up for us.
Other data geeks, yeah.
Let's talk about the data that you're receiving, even about today. So when I got up today, I put on CNBC, which is not always a good idea. Futures were down huge.
Yep.
Go for a walk, come back. They're back up somewhat. Is that there's a lot of reasons for that, but is that just noise?
Yeah, I mean, volatility is normal. I mean, it's always a concern because, the way we interact with the markets on a day-to-day basis is, okay, if there's a headline, okay, do I gravitate to the headline? Is this bad news? Is this bad news systemic enough to be a problem for the market historically? I mean, odds are the answer is no. I mean, systemic issues are rare by their nature, but it is always, that's the way we interact with the market. But it's a dangerous way to interact with the market because we know, historically speaking, markets bottom on bad news. So if you sell on bad news, you have this problem empirically with diminishing your returns, not improving your returns, which is sort of a mathematical way of saying, look, the markets are a discounting mechanism, and you never know what bad news is already discounted. And oh, by the way, it doesn't count that the market has gone up over the last 6 months. That's actually not a discounting mechanism. I mean, the last speaker was talking about momentum. I mean, the interesting part about when stocks go up, you go, well, that means that they must, at least over the long term, sort of gravitate and, 2 steps forward, 1 step back. But the more the market goes up, the more it goes up in the future, which is stocks are kind of the best leading indicator. So that's a little bit of a long-winded way to sort of think about bad news and news on a daily basis. The interesting part to me is that I think that discounting mechanism is best represented if you juxtapose fear in the credit markets, high yield credit spreads versus fear in the equity markets. So if you think about whatever it is that you're worried about, and we can talk a lot about, your individual worries, whether it be the job market in the United States, earnings, the concentration risk in the Mag 7, yada, yada, yada. That difference in terms of what you're worried about, can the market climb the wall of worry? The best thing I've looked at, and there's no certainty, is to look at when the fear in the credit markets, when credit spreads are narrow, which is to say that, look, there's always credit events. We're listening to them right now. But to say that it is generally speaking muted, and the credit markets can absorb those potential losses. And they're saying, hey, credit spreads are still tight. They're in the bottom quartile of their historic ranges. There's nothing really to see here in terms of systemic problems and bankruptcies. And then you juxtapose that with equity valuation spreads still being high, which there's more fear in the equity markets. That's usually a good setup. There's a linear relationship. The more fear there is in the equity markets relative to those usually smarter credit markets, the more likely the market is to go higher. That is still what we are seeing. Valuation spreads are still high, especially in the Russell 3000. And that's just basically a function of when investors sell anything they think is risky, they buy anything they think is safe, you get this gap, and it's usually an opportunity. And that seems strange to say, given that markets are up so much, but that is much more predictive when you look historically than markets going higher. So if you use, hey, markets are up a lot, I think I want to take some off the table, what history shows you is be careful, because that hasn't been a good indicator. And not only has it not been a good indicator, you usually want to bet the other way and actually lean into market momentum.
Ramona talked a lot about signal-to-noise ratio yesterday, and obviously works very closely with you, as do so many portfolio managers.
Like Quantius PM.
Yeah, exactly. Yeah. We were debating, should she be a quant? Or anyway.
Oh, I know.
Yeah, she's decided to stay doing what she's doing.
No, she should.
When you think about noise in that ratio, when you started in this role, it must be up multiples from when you started. How do you deal with that? The amount of noise that's coming to you in the marketplace.
Yeah,
because you're looking for signal within this.
Always. I mean, it's interesting. I mean, that's the best part of being sort of a statistician as it relates to the equity market.
Yeah.
Yes, absolutely. And it's always changing. So my original job when I came out of college was working for the government. I was a cost analyst on the B2 program. And look, it was really fun. I built really cool spreadsheets. It was go, no go for capital investment.
Sorry, that was fun? Okay.
No, I thought it was fun. Yeah, no, I got to fly to the Pentagon.
Okay.
I mean, it was fun. So, or I thought it was fun. Remember, I like data, so this is what I do. But at the end of the day, like, there's only so much data you can analyze as it relates to that. There's an endless amount of data to analyze as it relates to the market. So, I think that's great. The more data there is, the more, quote, noise there is, the more value, theoretically, I can add to our shareholders and our clients and our portfolio managers. So that's good for me.
A lot of the data that you get today is provided by the government. There's a lot of stats out there.
Yeah.
There's a government shutdown. Can you take a week off? Like, what do you do now because of the lack of, are there other sources that you're gathering data from?
Yeah, so I was in, actually, the first government shutdown in the sense that I had lagged pay. So I was a government contractor, so they were like, hey, we're not going to pay you. I was like, does this really happen? I just started here and I'm not getting paid. So look, there's interesting parts about government data, and I find most of it, and I actually just talked about this on a video, quite lagging. So when people sort of wring their hands and say, well, we're flying blind, we don't really have the data that we need, and I think that in some ways the equity market is telling us the data we need. Let me give you an example. So payrolls, right? That is, again, the way most people interact with their own economy, certainly in the US. Like, we feel the job market, right? Are our kids getting hired? Can they get summer jobs? Do I feel secure in my job? That is the way we interact with our economy. So it stands to reason that you would say, well, this is very important as it relates to the U.S. economy, so therefore it is important to us as investors. When you look at payrolls, we just had one of the biggest negative payroll revisions we've ever seen historically, certainly outside recession. When you plot that revision, either normalized as a percentage of payrolls or not, what you will find is an inverse relationship to what you think should exist as it relates to stocks. The bigger the negative revisions to payrolls, the more likely equity markets are to go higher over the next 12 months. Right. Sounds strange. Why? Because more often than not, you have already seen below average returns. So to put this together into what has happened this year, in some ways, the slowdown that we have seen in the job market was accurately predicted, and I'm being a little bit fast and free with the data, by the almost bear market we saw in April. So that was exactly what stocks going down was correctly predicting, was that payrolls would slow. Now, the question is, while stocks are up a lot, are they correctly predicting that this is actually a soft patch that refreshes? So instead of focusing on the government data that I just told you is lagged, can we look for a leading indicator somewhere that we do have data on? And in fact, we can. That's profits. Again, there's a linear relationship. The more profitable U.S. corporate America has been, the more likely they have been to hire. It's not 100% certainty. I can't guarantee anything. But again, there's that monotonic relationship. So for me, as somebody who looks at historical data, if you say, okay, payrolls, well, I don't want to lean into a trap there and sort of make a mistake. I know that statistically they're a lagging indicator. So as much as there's hand-wringing of we have no data, can I look forward to a leading indicator? Yes, I can, because we have profits every month and we're going through a quarterly earnings season right now. Again, no guarantees, but the more profitable corporations are, the more likely they are to hire over the next year, which justifies the fact that the market has already gone up. So, yes, I think that, is more data better? Yes, but some of that data is lagging, right? So not all data is created equal, and that's, I think, why it's so fun to filter from the noise from the signal.
What about the validity of data? Because back in the summer, there were jobs numbers that came out and then they were revised, and so people make decisions and then say, "Well, this isn't even useful." Is that new?
No, that's why when Pamela asked me to talk about payrolls every time on FidelityConnects, I'm like, ugh, not again. Because the payrolls, they're the most heavily revised data series, with the exception of the savings rate, which is even more revised. Don't even get me started on the savings rate. So if anybody tells you about the savings rate, remember, it's just the most heavily revised data series in history, next to non-farm payrolls. So look, it does create an interesting dynamic when the Federal Reserve says that they are data dependent on data that is heavily revised. So you sort of have to say, as a skeptic, that's interesting. However, I think it's just part of a wide, big mosaic. So that is the problem with thinking through what data means, and one of the reasons why you get these inverse relationships. So it just goes to show that I think history can really help. Because if you say, okay, there's revisions in payrolls, do we care about these revisions? And then you come up with this pattern of a very different relationship than you would expect, then it should give you a big red flag as an investor that, well, I can spend a whole lot of time on this, but it's risky from a historical perspective because it may not help me in the end figure out how to invest.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
I've always been interested in your perspective on the volatility index, the VIX. I was fortunate enough to be on the floor of the SIBO and saw that pit. This is one of the last of the open outcry. It's a very active group, and people like our clients and so on would think that the volatility index spiking is a scary thing, but you've actually said that indicates probably an upside to the market.
Yeah, no, absolutely. And I think Ramona said this as well. Where most investors see risk, we sort of run to the volatility because and statistically you can see it. The higher the VIX is, the more likely the market is to be higher, meaning it's a big indicator saying, hey, a lot of bad news has been discounted, which is never to say that bad news goes to good news. Bad news just gets less bad. Right. And it's that second derivative move that usually moves the market. And I think that, I wrote a piece early on in the year with the onset of tariffs about uncertainty. And I think it makes a lot of market narratives make sense logically. It's just unfortunate that the data often doesn't support it. So when you think about high levels of uncertainty, I would say, well, it's a very uncertain time. That means businesses will not spend. That means economic growth will slow, and that will be a problem for the stock market. So you can say, okay, we can empirically measure uncertainty in a lot of different ways. We have the data going back on tariffs and trade and monetary policy. We can aggregate it together. We can create an uncertainty index. We have data going back to the 80s, right? So you say, okay, we're at peak uncertainty. What has that meant? Same thing with the negative revisions in payrolls. The higher uncertainty has been, the more likely the market is to be higher. Why? Because usually when uncertainty is very high, it gets marginally better, which is never to say that we go from uncertainty to certainty, but we get less uncertain. And that's the market moving event. So again, it sort of highlights these pitfalls that you can, I think, make mistakes as an equity investor by saying, okay, it's a very uncertain environment. That means I should take some off the table. But no, when you look empirically at the data, it usually means it's already priced in.
So consensus is dangerous.
I think so. But I'm a skeptic, so.
Well, and we see a lot of consensus about, is this 99-2000?
Yes.
You want to talk about that?
Sure. I mean, it looks very, very different in the data to me. Start with technology as sort of a sector overall. This is very different than what we saw from a fundamental perspective in 99 and 2000, where you were at very low margin levels and ultimately operating margins went negative. This is one of the best secular operating margin trends that I have ever seen in the data that we have going back to 1962 on a sector basis. So these are deeply profitable companies that we did not see in 99 and 2000. And in fact, the valuation compression that we saw in technology stocks in that quasi-bear market in April was a reset that is usually a very good starting point. So as much as technology stocks have become marginally more expensive, certainly more expensive than they were in April, we are not at the elevated levels that we even saw just a year ago, right? Which is well below the relative multiple or absolute multiple levels that we saw in 99 and 2000. So that was a situation that I actually lived through at Fidelity. When you start making up multiples and, based on revenues or revenue growth or, PE to growth rates. So we're not even seeing that now. We're still talking about just relative forward PE or just absolute PE, where it's justified by the free cash flow driven by these companies. So another way to say it is, the technology stocks are, I think, 38% of the market cap. Well, they're like 35% of the free cash flow as well. So there's there's a symmetrical relationship between that is not something that we saw in 99 and 2000. So from the data that I look at, this just doesn't look anything like it.
CEO sentiment you've written about, it's not great, but it's improving.
Yeah.
And talk about that relative to just what you see in the market, but also what CEOs are concerned about from a tariff standpoint.
Yeah.
How does that all connect?
Yeah, I mean, it's interesting in the sense that we just talked about, the leading indicators and lagging indicators. Should we think about payrolls or should we think about profits? CEO confidence is yet another leading indicator. And that is usually the way it works. So for me, when you think about earnings growth being the key, and I know you've heard it enough, stocks do follow earnings most of the time. That's not always true at turning points, but it is the very definition of the core driver behind that, what I think is the continuation of the secular bull market. So the tax cut that we've seen early on is very meaningful from a tailwind to durable, high magnitude earnings growth, especially on a median level. Now, the interesting part is if you look through history, statutory tax cuts, ours is statutory, but it's close enough from an effective tax rate. When you look through a history, you don't usually see a throughput immediately to either GDP growth or earnings growth. But what you do usually see is a throughput into CEO confidence. So, and that is the interesting part about history. So when I wrote that tax piece, it was saying, yes, look for a boost in CEO confidence, because that's usually what you see in year one. In year two, you get the durable earnings growth and you get the GDP bounce. And that's exactly what we've seen so far. And that was actually, CEO confidence was at recessionary levels, despite the fact that we were not in recession. And that's usually the sweet spot, because when you're rising from low levels, that tends to predict better market returns going forward. So this is what I would say is a very historically a common setup, where you see a catalyst, then you see a boost in confidence, then you will see the boost in earnings, which is one of the reasons why I think valuation is not really a headwind for the market. It's just a reflection of confidence, because CEOs are getting more confident in future earnings growth.
You delve into history to look for patterns.
Yes.
And how far back can you go? How fast can you do that? And how do you use AI to help with all this?
Yeah, so how far back can I go? It depends on the indicator. So I just wrote a note that is not flipped to LinkedIn yet on CAPE. So the cyclically adjusted PE and what that has meant through history. So that data goes back to 1930s. Not all data goes back that far, right? If you wanted me to talk about Bitcoin, then we're starting to talk about it in 2010. Right, so it just depends on how much data that we have and what you are trying to predict. So I try and be flexible in terms of my timeframes. That said, when I'm looking for patterns in the data, and what I wrote about with the CAPE note is you can't stay constant, right? I can't take data from 1930 to present and say now that's predictive for the future years. You have to see the way data has changed. So whenever I'm looking at patterns, I'm seeing if those patterns are still true or if they've evolved, and if they've evolved, why they have evolved. So again, when you look at data in cycles, I'm looking for differences in cycles and then trying to see if those differences are predictive. So that's the way I assess patterns. As it relates to AI, so far, the way that I've used AI is to help me be a better writer in terms of, I got all this quant stuff up in my head. And sometimes like the translation as it relates to getting those ideas in a way that I think is easily understandable for the average person, AI is incredibly helpful. It does not do my data work for me.
Okay.
And I think that I'm not sure we'll ever get there, and I'm not sure that I will ever have that much confidence, because what I like about data is not the fact that it's static, it's the fact that you can argue about it. It's the nuance in the data that I not only find fascinating, but that's where the information is. So yeah, anybody can tell you that higher CAPE valuations lead to future lower returns on a 10-year basis. But I think it's interesting to think about how that curve has shifted, why it might have shifted, and why it might be wrong right now. So that nuance is, I don't think, something that AI is there yet.
Well, it's an interesting perspective on AI, and I suppose AI is useful to people however it's useful to them.
Right.
Some may want it for data, some may want it for writing, or what have you.
I think you're
It's really in its infancy in that respect.
Yes.
Let's talk about the U.S. consumer. Where do you think the consumer is right now?
Sure. So I think the consumer is fine-ish, right? Much like the job market is fine-ish. And I think that that's good enough for earnings. I think one of the more controversial things I say is that I think you would think that the U.S. consumer is a big portion of the economy, right? It's 70% of GDP, and GDP is really important for the way you think about equity markets. GDP and equity markets have not really gone hand in hand since 2000. And the entire reason behind that is because profit margins have been higher cycle to cycle. So we are seeing the juxtaposition that I think underpins the secular bull market of regardless of what you think about as it relates to the economy. because corporate America is more profitable cycle to cycle, even though the consumer is at the same level of growth. So when I look at GDP, I mean, we just talked about this on the compound. People usually quote, oh, GDP was just 3.9%. That's a quarter-on-quarter adjusted rate. Year on year in the US, I mean, I think consumption is probably a little bit above this because investment is below this, but real GDP growth is only 2%. We used to, back in the day, we would call that stall speed. Remember that? We would say, like, if you fall below 2%, then you're really at risk for a recession. So this is not a particularly robust environment at all. It's also not a recession. I think the same is true for the consumer. There's parts of the consumer that are deeply struggling. There's parts of the consumer that are doing fine. And on average, the consumer is fine-ish. Right? Which is not to say that every consumer is fine. But I think what I don't want investors to do is to say, okay, how is the consumer? And I say, it's just fine. Does that translate to the equity market? So is the equity market only just fine? No, I think the equity market has a much, much more constructive setup than consumption.
So the consumer being an ish is vulnerable, but you're keeping an eye on that.
Sure, I always keep an eye on it.
Yeah, of course. Let's move to Canada and talk about energy and gold.
Yes. Yeah. So, all right, let's talk about energy. So energy is one of my biggest bones to pick with our diversified portfolio managers, because usually when they think about recovery, they want to own energy stocks. And I do understand that, because energy is one of the only sectors that when it works, you get earnings growth and valuation expansion. That's actually pretty rare in cyclical sectors. So you get a lot of upside if you get the cycle right. The problem that I have with energy, and we can talk about excess supply in a second, the problem that I have with energy is the renormalization of operating margins or returns relative to history. Meaning, 2022, we have the data going back to 1962. 2022 was the most profitable energy companies have ever been on my data set, right, with the spike in oil prices. And from that, we are still above trend. We are still renormalizing, which means operating margins are still deteriorating. And that is not a good setup, historically speaking, for energy. And you say, okay, Denise, but you just told me that the market's a discounting mechanism and energy stocks are cheap. Doesn't that mean that they've priced in the operating margin compression? No. Energy is the only cyclical sector where you get trough margins on trough earnings, meaning that you are not paid to be early in the energy sector. There is always more downside than you think because of that historic setup from a relationship perspective. So I think that we are just not there in terms of normalized fundamentals. So my biggest bone to pick of the energy sector, why I think that the risk reward is not positive, is that renormalization that we still are in the early stages of. However, we do have an excess supply issue. So the interesting part is, when people talk about either OPEC cutting or hiking, I think, again, it's one of those interesting empirical things where the data works the opposite way that you would think. So you say, okay, OPEC's cutting, and that withdraws barrels from inventory. That means if inventory is lower, prices should be higher. There's no historical relationship between inventory levels relative to historical averages and price. I know that that's very highly disputed, but I can show you the data, which is to say there's no consistency. Why? Excess capacity is 10 times more important than inventories as it relates to the price level. Said differently, the market's smart. The market knows that if OPEC's cutting barrels, those barrels can come right back on, which means your upside is capped from a price perspective. So that excess capacity that we see in OPEC cuts and in shale production is meaningful, will likely weigh on price, which will likely continue to weigh on earnings, which likely continues to weigh on the normalization. So energy is a negative risk reward.
Well, I believe you on all that. All right, this is a discussion you get into with the energy side.
Yeah.
And it must be quite heated.
Yeah, it can be. It can be. Yeah, well, I mean, heated in a good way.
Yeah.
Right? None of us know the answers. I'm just presenting the data as I say it.
I think you know the answers. Gold. Let's talk about gold.
Yeah, gold is tricky. So, everybody said, what does this gold move mean? I'm not going to be helpful here, because I will tell you that gold is not consistently correlated to anything. We're actually, the gold analyst, Boris, is going to be on my webcast that I do for clients because everybody wants to talk about gold. And he's like, well, this is about the dollar debasement and this is about interest rates. And I'm just not so sure because gold has changed its stripes many, many times historically. If you had to say, Denise, I need you, and you're saying this, Denise, I need you to say something conclusive, I would say gold's closest correlation is actually to commodities, not real interest rates, not inflation, not the dollar, not currency debasement. That's the closest corollary, which means it's driven by supply and demand dynamics. And it is definitely the best supply and demand commodity. Forget for a second central bank buying and dollar debasement, but just when you think about structural growth as opposed to energy that I talked about as in chronic oversupply, there's not a chronic oversupply of bullion. So you have a much better supply and demand dynamic from a commodity perspective. I am cautious still on the miners, which has been wrong. So Denise Chisholm, very wrong year to date on the miners because that cycle to cycle, they have destroyed free cash flow. Could it be different this time? Maybe, certainly, because bullion has gone up so much, they are showing much more free cash flow. But again, when you sort of think about the long term over time, if you're asking me and portfolio managers do, would you rather own semiconductor stocks, software stocks, technology, capital markets, brokers, parts of consumer discretionary, or gold miners? I would lean all the way over here. So I'm much more recommending overweights in technology than I am in metals and mining.
Urian would connect gold to crypto as far as in the same sentence. So not that they're the same, but in the same sentence. Let's talk about crypto.
Yeah, I think in the same sentence is right because it's theoretically digital gold. The problem that I have is, again, back to the data. So I was just on our crypto webcast, and forget what it should be, tell me what it is. The closest correlation from Bitcoin perspective is to the equity market. It's not to gold. It's not to bonds. It's not to the dollar. The highest correlation is actually to unprofitable technology. So to me, I think that there's a lot of talk about, Bitcoin potentially diversifying assets. It looks a lot like mathematically a triple leverage play on the NASDAQ in my work. So I think you have to make sure that you understand at least what it is acting like right now, which, look, I'm bullish on the equity market. I'm bullish on technology stocks. So that makes me bullish on Bitcoin, which I think is interesting. When you lower interest rates, you would think that lower interest rates mean you should buy equities, and you can't see that empirically. I think it is true this time, but you don't see like that linear relationship in the data. In Bitcoin, you do. It's so interesting. In Bitcoin, there is a perfect monotonic relationship between lower 2-year yields and future price rises in Bitcoin. And you would think, well, maybe that is that hedge of, if lower interest rates are reflective of a really soft economic environment, then maybe you want to own Bitcoin. But then you say, well, if earnings growth is good, my hit rate even goes higher. So it sort of shows you that Bitcoin is the levered play on things that you would think would be the levered play for equities. So I do think that I'm constructive on Bitcoin, but I think you have to be careful in terms of thinking it will act in a way that so far it hasn't.
Makes sense. We're in earnings season, earnings growth. I know you have comments around that.
Yes. So it's been a unique cycle. So cap-weighted earnings growth in the U.S., probably everybody knows, driven by technology stocks, has been fine, right? So the trough, I would say the very hard soft landing or the very soft hard landing was in 2022. That was what I would deem an earnings recession, right? So earnings contracted by about 7.5% to 10%, depending on how you calculate it. And we've been rising on a cap-weighted basis ever since. So you say, okay, this is what has been driving stocks higher. Now, what has been different this cycle has been that the median earnings for the companies has actually still been in a contraction. It's been one of the longest contractions that we've seen since COVID and the financial crisis. So these are very not COVID, so since the financial crisis. So, and it looks more like those typical recessions. This has been unique in that the differential between cap-weighted earnings and equal-weighted earnings has been the most durable on record, meaning that usually cap-weighted earnings recovers, then median earnings recovers within like 6 months. Ours has been double that lag. So again, backing up, you say, okay, well, what does this mean? So we've seen a durable earnings contraction on a median basis that we seem to be just emerging from. What happens when you just emerge from a very durable earnings contraction? You usually have a durable earnings recovery. So the longer your earnings duration contraction was, the more durable your recovery is, and the higher the magnitude is. This is supportive of that secular bull market. Said differently, that was a lot of math. Said differently, we're finally getting diffusion, right? I think that we have the catalyst in terms of the tax cuts, the Fed lowering interest rates, the median earnings of a company recovering. And I think that that makes it very likely that earnings growth is durable, not just this year, not just next year, but maybe for much longer than you think, which might mean that valuations are not nearly as high as everyone is calculating, which means that they are not the headwind that investors think. So look, stocks do follow earnings. And when we're thinking about noise versus signal, I think you always have to gravitate back to what is the base case. And right now, earnings are getting stronger and more diffuse, which is usually the driver for equity markets.
So picking up on valuations, is momentum breeding momentum in the market?
Yes, and it has historically. That goes back to I know that people want to use price as well, maybe it's up a lot, so I should take some off the table. Look, I mean, you can do whatever it is that you want to do. However, I would tell you that over the long term, that strategy does not work, meaning that the more the market goes up, the more the market is likely to go up, which means kind of in a way like that stocks are more likely to get it right than the government data is, right? If you go back to that payroll analogy, right? If payrolls, the more negative payrolls are, the more likely markets are to go higher, and the more likely equity markets are to get it right, then the market actually figures out the data before the data is even predictive.
And is the converse of that where when we see demise of the market, there's a spiral because it kind of feeds itself?
Yeah, well,
the momentum either direction?
Yes, it definitely works both ways. I mean, and that's sort of getting back to valuation. That's the dangerous aspect of valuation as well. So if you go back to, everybody says valuation is a poor timing indicator. Here's an example of that. Stocks in 2008, they got as cheap as 10 times earnings in October. And then stocks fell 30%. When they bottomed in March 2009, they bottomed at 15 times earnings, right? And the problem was not the PE, right? The problem was the E. To your point, is that we weren't 10 times earnings because earnings were too high. That's why that earnings is the key signal, and the market sometimes, at times, correctly predicts the demise of earnings.
Okay, there's probably a few people in here thinking this. Okay. You've been a secular bull for a long time. What's going to change that?
Yeah, so there's three things I look at. That is the right question, and it's true in terms of if you ask me, like, Denise, you're always predicting Goldilocks, and I do always say, like, it's true. Goldilocks actually has the highest odds. Don't forget that. And if you think about, Denise, you're just a cheerleader for the secular bull market, true. However, you should remember that on average, any given year on a rolling 12-month period, stocks go up 75% of the time. So that should be your sort of entry point, at least when I think of from a historical perspective, because if you're a little bit, too cute by half for that, you can miss out on returns structurally. So, but the things that I look at, there's three at least. First of all, credit spreads. We talked about how narrow they are. That's usually a good thing until it's not. So for me, what I worry about is not bad news. It's really good news. So really, really narrow credit spreads, which we're not there, right? Bottom 5% of history, we have the data back to 1980. That's usually everything's priced into the upside. At the same time, look, there's a bunch of good leading indicators, right? So we're actually, if you sort of plot this from an oscillator perspective, what you can see is we're not even really that far above median levels, meaning that we've still got time to get to what people would call peak economic growth. We're just not there yet. But that would be a point at which the risk reward usually shifts off, right? And the third one would be around valuation spreads. When valuation spreads are very narrow in the equity market, and credit spreads are rising, that's what we saw in 2009, that's what we saw in 2001, when the credit markets are saying, hey, we've got some bankruptcy issues, and the equity markets are saying, nah, it's all going to be fine. That's a dangerous setup. So for me, I'm looking for really good news, like earnings growth above 25%, the OECD LEI in the top quartile, credit spreads below the bottom 5%. That's usually a poor setup because it usually means all of the good news has been priced in. So that's what I look for, but we're not there yet.
Unfortunately, we have to wrap very soon. I've got a few fun questions about you.
Okay.
First job.
Fun. First job. Oh, it was a government one. Yeah.
That was your first job. Yeah. You didn't paint walls or... Okay.
Oh, like first job ever. So I worked at Berman's Leather.
What's the name?
Cherry Hill Mall. Berman's Leather.
In the Cherry Hill Mall.
Cherry Hill Mall.
Okay.
Yeah, I sold a leather outfit to Reggie White, who was in the NFL for the Eagles.
So cool. Netflix or Amazon Prime?
Netflix. Yeah.
What song's most likely to get you on the dance floor?
Living on a Prayer, Bon Jovi. I'm from New Jersey.
Yeah, Neil Constable told me the other day, he said you're a real metalhead from New
yeah,
Jersey.
totally. Yeah, we jive on that.
Hair metal. Yeah. Go-to coffee order.
Oh, black. Anything. Doesn't matter.
How many have you had this morning? That's just my question. Okay.
3.
And favorite podcast right now, other than your own?
I was just going to say, can I say mine? Oh, no, now it's the Compound and Friends.
Yeah, that's
I
great.
did not know about before. No,
Which is the one we talked about with Yuri and Peter Lynch was just on it as well. I could go on and on. You did say at the beginning of our discussion that there's times you don't have answers, and I don't think that's physically possible. You know what? We have 1 minute.
Okay.
If a client comes to one of our advisors and says, I'm nervous about the market, what's a quick answer?
Just be careful. Markets are a discounting mechanism. They go up more often than you would think on bad news, right? We've seen that over the last 5 years. Think of all the things that have been wrong, right? We've had COVID, we had lockdowns, we had an inflation scare, we had a banking crisis. We might be even in the throes of another mini banking crisis. Markets are up 70%.
Enough said. Denise Chisholm, thank you very much.
Yeah, great to be there. Yeah.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.